next up, we have a presentation from Westgold Resources with a ticker code WGX, a growth-orientated WA gold producer. So to tell us more, today we are joined by Managing Director, Wayne Bramwell. Good afternoon, Wayne.
Good afternoon, Jane. From Cuba to Kew in Western Australia.
Lovely. Let me bring up your presentation.
Great place to start. Thanks very much for the time today and the opportunity to tell the Westgold story. Westgold is a West Australian gold producer, and the value proposition in some sense is quite simple. The business is now profitable, producing 257,000 ounces of gold last year at an all-in sustaining cost of just under 2,000. Currently, and these are A dollars, at the end of September, we are sitting on $217 million worth of cash. Importantly, we're debt-free and fully leveraged to the gold price, meaning there's no fixed forwards in place. We now collect every dollar of the $8 gold price, and we sold gold this week at 3,015, likely to sell gold today at 3,080 Aussie dollars. Importantly, in terms of building value over the last 12 months, for the first time since 2017, we've grown our mineral resource. That was a function of spending $19 million on drilling last year, and with that drilling, we increased the grade of our reserve. Something key, a key differentiator for Westgold is we mine our own ore bodies with our own people and our own equipment. We're vertically integrated. We've got a specialist underground expertise, and that gives us an advantage when it comes to underground mining. The business, all West Australian assets, where many of our peers have offshore assets. Our home is WA, and really our assets sit between the regional towns of Kew and Mtpa. And looking at this slide, think of the business this way. 50,000 ounces per annum comes from the Bryah operations. That's a single processing plant and one underground mine. The other box between Kew and Mtpa, 2 processing plants generating around 210,000 ounces per year. The share price has performed, has outperformed our peers in the last 12 months. And this is really a function of us starting to hit our targets and delivering on what we tell the market we were going to do. The business in the last 12 months has gone through a significant turnaround, and I'll talk a little bit to that on the next slide. But the long story short, there's still a lot of headroom in terms of where we think the value of the stock is, because this company still trades at a discount to its peers. Westgold set about some significant changes in the last financial year. We refreshed the board and the management team. We focused very much on improving our safety culture here and took a far more disciplined approach to the way we were operating our mines. We've delivered our production and cost guidance for 2 years in a row. That's starting to build some trust in the stock again in terms of our ability to deliver. Most importantly, in July this year, our fixed forward program, which has been the burden of many Aussie gold producers, was finished. So as I said, fully exposed to the gold price going forward. We've now built cash on our balance sheet for 3 quarters in a row and are set to do that again this quarter. Our approach to safety has been significant, and one key metric when comparing many gold companies is this Trifer Rate, total reported injury frequency rate. In some sense, 2 years ago was extremely high. That made the business uninvestable for many, and also a difficult sell when it was coming to employing people. Very happy to say now that our Trifer is better than many of our peers and trending down. And comparatively, what does a good Trifer Rate look like for Aussie mid-cap golds? Somewhere between 9 and 4. Where it's sitting at 8, pushing down to 7, I believe we can get our safety rate down to around 5. Cost. Again, all Australian gold producers are price takers. It's not something we can control, but the good news is at the moment, with the Australian gold price being over 3,000, we collect every cent of that. For the last 12 to 18 months, we've been really focused on driving costs out of the business. That's really about trying to find more efficiencies. And this slide simplistically shows July 2022, our cost, all-in sustaining costs on a monthly basis being around $47 million. We've now been tracking down for over 18 months, and this slide is trying to show the reader that in terms of being on top of our costs, this business is. We had to get on top of our costs because we were a high cost producer. The target for this year is to deliver at the bottom end of our cost guidance, which with a cost guidance range of 1,800 to 2,000. This has been the game changer for the business over the last 12 months. We've underinvested in drilling for 5 years previously. Last year was the first year that we really got busy in terms of trying to replace the gold that we were mining. And I'm happy to say we were successful in terms of lifting the resource number and lifting the reserve grade. Under investment in drilling for 5 years, you can't fix in 1 year. So last year, again, we basically stabilized things. This current financial year, we expect to see our reserve grade or our reserve ounces grow, currently sitting at 2 million ounces. This is probably the most important slide in the whole deck, and it's really showing the cash build in the business. We set about a strategy in the previous financial year to change our cost structure, drive cost out, become more efficient, become more disciplined about what we do. We did. We closed 3 mines in FY23, underperforming mines. I'm happy to say we brought one of those back. There's another one which is sitting there ready to go. The significant change that shareholders have seen in the business in the last 12 months has been Westgold's ability to add cash to the balance sheet. I've said before that we're 3 quarters into this turnaround. We've been building cash every quarter, and the business is now structured to consistently deliver cash to the bottom line. What's our plan to close the trading gap that Westgold has against its peers? It's really simple. Continuing to deliver, continuing to invest in the parts of the business which actually drives cost out, makes us more efficient, and continuing to invest in our people. Key to changing the perception about our company, and for some, this is a new old story because Westgold has been around since 2017, is showing that it can consistently build cash, it can consistently extend its mine lives, and continually show returns to the shareholders. In FY24, the current year, after FY23's turnaround, our focus really now is about investing in our people. And that's not just about paying them more, that's about providing more opportunities for them, increased training, increased benefits, because for those of you not living in Western Australia, there's a war on talent in WA, and we are finding ways and novel ways to try and compete to make sure we've got the best people operating our mines. Changing the perception of the business has also, as I said, been driven by drilling. Really happy and really proud to say in the last 12 months, we've actually we've done some really great things. Great Fingal is one of the highest grade mines ever done in Western Australia. For those, it is a name that is well known in this part of the country, and it was a very proud day in August this year when the board approved the development of this mine. This mine has a 12 to 18 month lead time. We started this mine in October. We're expecting it to generate 50,000 ounces of gold at an all-in cost of around $1,800 an ounce from FY25. Only this week did we announce the expansion of our largest asset, Big Bell. The Big Bell expansion is something that we've been working on for 2 years, and it was another significant day this week to announce that the board had approved the expansion of this mine. Big Bell now has 16 years mine life in front of it, and that's a significant change for where it had been. There's very few mines in WA that can boast 16 years of life ahead of it, and with Big Bell now defined over 16 years, it locks down one end of our business and gives us a lot more flexibility as to what we do. The other change in the business over the last 12 to 18 months has been the start of a new mine called Bluebird at Mtpa. This was a small mine originally, 250,000 tonnes per annum, at around 4 grams per tonne, an underground mine like all of our assets, which we've doubled in scale in the last 12 months. We've been drilling this mine and operating it concurrently, drilling it with 3 rigs for over 12 months now. We think we can make this mine bigger, and there'll be an announcement in the new year about, again, increasing the scale of this project. A significant way to drive cost out of the business, and our business, like most underground miners, is dominated by diesel consumption. We Our projects are not on any national grid, so they've been predominantly powered by diesel-fired power stations. Being our own underground miner and having 140 pieces of underground gear, we used to consume a lot of diesel, 8.5 million litres a month to be exact. In the last 12 months, we've been working with a group called Pacific Energy in terms of helping us transition to gas, solar and battery power to power the bulk of our operations. 2 of these hybrid power stations are now fully online. Over the next few months, the other 2 power stations will come online. What does this do for us? It basically drives diesel out of our business, or drives our consumption down, currently sitting at around 3 million litres a month, soon to be 2 by the end of the year. It drives emissions out of our business, but most importantly, it drives our costs down. And the transition to these hybrid stations should drive between $60 and $80, $60 and $100 an ounce out of our all-in sustaining cost. We speak to this slide about the change of the dividend policy as evidence that the business is now starting to become more sustainable. Westgold had paid a dividend in FY21, and now we've structured to be able to consistently pay returns to our shareholders under these terms. My gut feel is that in February, once we announce the half-year results, we'll be in a position to pay the first dividend under these terms to the shareholders. Half-year numbers are finalised in January, audited and signed off in February. That'll be a time where we'll make an announcement about a dividend payment. The last slide. I've tried to keep this short and punchy. I encourage anyone who's interested in Westgold to hit our website or check out our social media. But the strategy for FY24 is really simple. Continue to build free cash. Free cash and building our cash balance gives us optionality over expanding our current asset package, increasing our drilling, and also gives us optionality over inorganic opportunities which we see emerging. The focus is still the same, trying to drive efficiencies up, cost out. How do we leverage our existing capital better to generate a higher return for our shareholders? We won't slow down on drilling. This year, the budget is $20 to $25 million, and I want the exploration team to spend every cent of that, because the 19 that we spent last year generated a fantastic return corporately, and will do so again this year. We'll continue to invest in technology that reduces our costs. The last 12 months has not all been about slashing costs. It's been about being smart about where we deploy our capital. The clean energy project and these hybrid power stations has been key to that. The other key investment has been into underground loaders, which are now hybrid diesel electric. We love these new Caterpillar machines because they use less diesel, they're more powerful, they put less emissions into our mines, and they're just good business. That drilling is also really focused on continuing to increase the mine life of our current assets. And as we sit here today, Big Bell, 16 years. Great Fingal starts life with an 8-year life. Bluebird, 3 years and growing. Starlight, 3 years and growing. Fender, a small mine at Kew, 3 years. Paddy's Flat, 2 to 3 years. So we are very much focused on drilling these assets, and we do that with their own people and our own equipment. In terms of M&A, which is the question we get asked often, my response is this. M&A is a complicated way of buying things. What we've found by spending time drilling our own assets is a lot of our assets are under-drilled, and our M&A metric is looking at spending $1 on our own assets versus spending $1 on other people's. We've yet to find a better opportunity than our own. Really, that's the Westgold story. It's a very simple story. We're on track to deliver 265,000 ounces of gold in this financial year. We're targeting the bottom end of our guidance, somewhere between 1,800 and 1,900 all in Aussie dollars, all in per ounce. We are debt free. We are unhedged. We've recently announced that we've got a $100 million corporate facility provided to us by Societe Generale and ING banks. So we've got plenty of horsepower to invest in our own assets or to take advantage of opportunities we see emerging. Jane, that's the Westgold story.
Wayne, what a great presentation and a great company, which is pretty evident by the share price growth that you've had over the past few years. But let me just quickly jump into it, and perhaps maybe one you might not be able to Oh no, you've answered a lot of the questions already. But so you talked about investing in organic growth. So what drilling programs have you got planned for 2024?
As we sit here today, we've got 10 rigs across our package, 3 rigs drilling our Bluebird mine intensively. The Bluebird mine is literally a few hundred meters away from the Bluebird processing plant. It's a shallow mine. In some sense, we can't drill a bad hole there, but that is a place where we can add reserve ounces very, very quickly. We will do some more drilling in Great Fingal. We'll do some more deeper drilling in Big Bell, but we're also starting to do greenfield work, looking for the next suite of assets. So prime focus of the 25 million budget, 75% of that is basically drilling and extending the mine lives of our existing mines, making our bigger mines bigger. 25% of that 25 million is really focused on greenfield stuff within the package of between Fortnum, Kew and Mtpa.
Wonderful. Well, looks like you've got a lot of news flow coming into the new year as well. But anyway, again, great presentation, and thank you for joining us on Broker Briefing.
Thank you very much, Jane. And again, hit the website for anyone who's interested in more information.